All right, so the next one here, sorry, we got a bit of a weird, oh well, there we go. Perfect. All right, so now we're going to get into debt investments that are classified as trading securities. So this is going to be a little bit longer. I actually might have to break this up into two different lectures, depending on how long it takes us. So we'll see. So we have trading securities available for sale securities, and then we've got equity securities as well. So lots of topics left on this one. Sorry in advance, but we're going to kind of make our way through. So again, regardless of the classification, whenever we have debt investments, we have to amortize them. We're going to report interest payments and interest revenue. All that's going to be the same regardless of the classification. But unlike held to maturity securities, trading securities also have some additional things going on. And more specifically, we report them at their fair value. So again, held to maturity is reported at amortized cost. Trading securities are reported at the fair value. So that means we've got a little more work to do when it comes to trading securities beyond what we did with held to maturity. Those changes in the fair value are going to be recorded as unrealized holding gains and losses, and that will be reported as part of net income for trading securities. So those gains and losses are going to be in a temporary account. That temporary account is going to get closed to retained earnings at the end of each year. So there will be this additional account as well. So on the balance sheet, it does the asset needs to be reported at the fair value. And so if you remember with held to maturity securities, we had the debt investment itself, potentially a premium or a discount. So that's two accounts. Now on top of that, we're going to layer in this fair value adjustment account, which gives us a third account. So when we see a balance sheet report for the debt investment, there's actually three accounts. There's going to be the debt investment, a premium or a discount potentially, and the fair value adjustment. So there's actually three accounts that are going to show up on our balance sheet. So a lot going on when it comes to trading securities. All right, so here's our example. 49er Company purchases 808% annual coupon bonds on June 30th, 2025. They acquire them at 101 and a half. Each bond has a par value of $1,000. The bonds pay interest on December 31st each year, and they mature on December 31st, 2030. The fair value of the bond is 101 at the end of 2025. They sell some bonds in April of 2026. And then again in 2026, there's another updated fair value of 102. And so there's trading securities, and we're going to kind of take it from there. This one's a little easier in that it's annual coupon bonds. It's a little harder in that we acquire it on June 30th, 2025, which does not sync up with an interest payment date. So we've got a little bit of work to do when it comes to that. So we're going to do the journal entries for June 30th, which is the acquisition. The end of that year, we're going to do the sale on April 30th, and then we're just going to do one more adjusting entry at the end of 2026, just to kind of get our ideas. And of course, just like we did with held to maturity securities, we are going to go through the financial statement effects. More than likely, we won't be able to fit all this into one lecture. It'll end up probably being two. We'll see though. All right, so thinking about the purchase, hopefully this isn't too bad, but one little thing to note, again, we've said it before, I'm going to say it again. When debt investments are purchased between interest payment dates, the buyer must pay the seller of the investment any accrued interest, and I would say contractually accrued interest as of the transaction date. What does that mean? It means if I'm buying the bond on June 30th, 2025, I have to pay the seller of that bond whatever interest has accrued for the first 6 months of 2025. Again, because they're contractually entitled to that interest, but from a bondholder's perspective or the bond issuer's perspective, they're just going to pay it to whoever holds the bonds on December 31st. And so I'm going to get the full interest payment, even though really I only held it for 6 months. And so in an efficient market, someone's not going to forego 6 months of interest. And so I've got to pay them for that. Now, admittedly, there's probably a little bit of a time value of money element in there that we should account for, and you're going to see that that time value of money element does create a little bit of an accounting rounding that we've got to deal with at the end. But again, we're just going to kind of keep it simple. And so the debt investment, again, we bring that onto our books at the par value of $1,000 per bond. So we're going to debit that account $800,000. The premium is again that difference in the purchase price and the par value. So we bought it at 101.5, which means we have a 1.5% premium applied to the par value per bond, and again applied to 800 bonds. Means that premium is going to have an initial balance of a $12,000 debit balance or $15 per bond. The interest receivable. So this is a new account, but essentially what we've done is we've paid the seller of for that interest, half a year's interest. Again, the contractual rate for a year is 8%. And of course, we're only paying them for half a year. So we're paying them $32,000. But I'm going to get that interest at the end of the year. So we're going to classify that cash payment as interest receivable so that when I receive the payment at the end of the year, that receivable is going to come off the books. The cash, of course, whenever we make that payment, we are going to have to pay them the purchase price, and we're going to have to pay them that contractually accrued interest. The purchase price again is 101.5%. The contractually accrued interest we just calculated is 8% times 1,000 times 800 times 1/2. And so the total amount of cash that I'm going to have to pay is $844,000. And of course, that's cash that I'm paying. And so that's going to be a credit. And so I just take all that information, the 3 debits and the 1 credit, and I throw it into my journal entry. Again, hopefully, other than the partially accruing of contractual interest, this is exactly what we've done several times. So hopefully it wasn't too bad. But from there, of course, because this was purchased at a premium, we do need to apply the time value of money. We're going to amortize that premium over time using the effective interest method. And so again, hopefully we've done this before. We use time value of money. The only nuance here is, there are 5.5 annual periods left because we acquire it on June 30th. And so the N is 5.5. Everything else is just according to the contract. So the payment is $80. The PV is 1,015 and the FE is 1,000. And so when we solve for that, we get a bond yield of 7.6557%. Now the TVM table or the amortization table is a little bit unique. Now I will say for my students, I'm not going to test you in a situation where it's like a partial year. You might have to do a calculation, but you're not going to have to create an amortization table or anything like that. So given that, I'm just sort of alleviating maybe some concerns for my students, but we do need to walk through how we do the accounting. So in the amortization table, even though I'm going to receive the full $80, I am going to receive $80. But because I'm only contractually sort of receiving 40, right? Because I kind of netted, if I kind of think about it, I paid 40, I'm going to get 80, so I net receive 40. That's what we're going to put into the amortization table. And then the interest revenue, that 7.6557% is applied to the 1,015, but it's half a year. So we're only applying, so we take the full amount, which would be 76 or 70, yes, almost $77, and we're essentially dividing that in half. The amortization is the same, it's just the difference between the two. So there's $1.15 of amortization. The initial premium balance of $15 is reduced by the amortization. So there's a new balance of $13.85. So the new amortized cost is $1,013.85. And then the rest of the amortization table is as we've always known it, except for, like I said, because we're kind of creating a linear relationship in that first 6 months, but it's TVM is nonlinear, we end up getting a slight rounding error at the end, and we just basically make it work at the end. All right. So the next journal entry we've got to worry about is the December 31st, 2025 journal entry, which is that first interest payment since we've owned it. And so we are going to receive $80 per bond. Again, just reminding ourselves that this interest payment is the net amount. I prepaid 40 out. I'm net receiving 80. So I am receiving $80 per bond. That is the cash that I will receive. Times 800 bonds is $64,000. The interest revenue we're taking from the table, $38.85 per bond times 800 bonds. Our interest revenue is $31,080. We're going to remove the interest receivable from our books. So again, we have accrued that interest receivable based on the cash payment that I made, knowing that I was getting that cash back. Now I'm getting that cash back. So the interest receivable is 32,000. And then finally, we do need to amortize the premium. It's $1.15 per bond times 800 bonds, which means our amortization is $920. And again, mechanically, it's all got to work out. And so that's where we land after that first interest payment. So now we're going to do the fair value adjustment. So this is a new one for us. And so again, with the trading security, we want to carry the security at the fair value. Right now, it's recorded at the amortized cost of $1,013.85. And that's a combination of the debt investment plus the premium. And so now we need to do an additional journal entry in order to get the fair value adjustment and in order to update the balance sheet and make sure we report that fair value on our balance sheet and record any gain or loss on our income statement. And so when we make that calculation, what we're doing is we're comparing the fair value of the investment to the amortized cost. The entry is going to be the change in the balance to the fair value adjustment account. So there is a new account called a fair value adjustment account. That is going to be the focus of this journal entry. Now, the nice thing is this is a brand new debt investment. And so when we talk about, at least initially here, the prior fair value adjustment account balance, there is no prior balance. And so initially the journal entry is a little easier to do. And so we go through this process every single time. And that first step is you start with the fair value of the bond at the end of that day, so on the December 31st date. What is the fair value on that date? And we are given that information. We're told that it's 101% of the par value. And we're going to initially track everything per bond, and then you're going to see later on, we're going to apply it to the number of bonds that we have. And so in this case, the fair value is $1,010 per bond. We compare that to the amortized cost per bond. The amortized cost per bond is $1,013.85. We take that from the amortization table. The fair value adjustment account balance is the difference between the fair value and the amortized cost. And so in this case, you can see that the fair value is less than the amortized cost, which means if we reported just our amortized cost, it would be up here. But we're told we need to report that bond at its fair value, which is down here. And so if you think about that balance sheet, we need a negative balance in our fair value adjustment because we're taking it from $1,013.85 down to $1,010. And what does that mean? It means that the balance per bond is a negative number. It's negative $3.85 per bond. Now, when we compare that to the prior one, we don't have to worry about it because the prior balance was zero. So the change in the account is $3.85 per bond times 800 bonds for a total of $3,080. Now, the question is that a debit or is that a credit? Because we're building out a journal entry here. And so is that a debit or a credit to that account? So again, this is an asset. It's a fair value adjustment account. It's an asset. That account is being reduced. And so when we reduce an asset, we reduce it with a credit. So we are going to credit the fair value adjustment account in order to decrease the account from zero to negative $3.85 per bond. That credit is going to be offset by a debit to a gain or a loss account. We're going to talk about that account. I know it's a new one. When we get to the next slide, we will talk about that account. And so again, the fair value adjustment on December 31st, 2025, we're going to be crediting the fair value adjustment account, and we're going to debit this gain or loss on investments, unrealized net income account. Now, I will say, I've taught from 3 different textbooks, and I've seen this handled 3 different ways. So the way I'm doing it is consistent with the McGraw-Hill textbook, which is the one that we teach from. There are parts of that I like, parts of it I don't like, but in order to reduce confusion for my own classes, I'm just going to teach it the way that they teach it in terms of account names and things like that. And so in this case, we're going to kind of carry this account as one singular account where it could be a gain or a loss at any given time. And so we're going to allow that account to bounce in between gains and losses. And so the way we're going to do it is we're going to classify it as a revenue account, knowing that when it has a debit balance, effectively it was like a loss. So it's going to be like a negative revenue. Again, Arguably, you could have two separate accounts. You could have a loss account that's in the 500s and a gain account that's in the 400s. We're just going to combine it into one account, and just allow it to have a debit or a credit balance, knowing that when there's a debit balance or when there's a debit entry, that's a loss. And when there's a credit entry, that's a gain. And we're going to kind of aggregate them together if there are multiple entries in any given year. But again, what's driving this is there's a credit to the asset, and that credit to the asset drives a debit to the temporary equity account. Again, this account would get closed to retained earnings at the end of the year. All right, I'm right at 15 minutes. And so we are going to stop there, and we're going to start with the sale, the April 30th sale with the next slide. So, or with the next lecture. We're going to stop there for right now.